So hello and good afternoon. I hope you can hear me fine. Let's just have a look here. Yes, perfect. So the screen should be clear to everyone. NFPs ahead, which scenarios to expect, and yeah. So we want to have a look at what to expect tomorrow from the non-farm payrolls. In fact, the non-farm payrolls have been one of the most interesting data sets out there for a long time, and still they are very interesting to watch. But I have some doubts whether tomorrow's NFPs can really trigger that much volatility, to be honest. And I will guide you through my doubts here. Nevertheless, we can definitely draw some interesting potential interesting setups here based on the current price action, especially in gold. You may have seen it that we dropped below 1,260 USD per ounce, but also some interesting price action, which can be seen in the dollar Japanese yen right now. So what I've prepared here is the question: why are the NFPs tomorrow interesting to watch? And so next week, this is something we have to make a topic here too. Next week we have the Fed decision next Wednesday, and somehow one could say that the NFPs here are tomorrow's NFPs are the last chance to change something in terms of market expectation around the rate hike of the Fed here in December. And I put this already here behind. It's not really the case. So in fact, tomorrow's NFPs will not change anything here. So especially if they disappoint here, we shouldn't expect that the Fed will react to this data set at all. But it's also the thing. If you look at the Fed at the rate decision next week, what is most interesting about this decision is that we don't really know. Oh, you can't hear me. Hello. Okay, one second. Let me just. Okay. Huh. One second. Hello. Hello. So now the question is, can you hear me? Can't you hear me? Just let me have a look here. May have seen it that. Oh, I can hear myself here too. Good sound. I hear you. Okay. So everything's fine with the sound then. Or let me put it that way. What was the last thing you've heard here me saying? Was it why? Well, yeah, obviously what I just talked about, where the Fed decision next week. So right now, I'd say one could say that the. Okay, 1 second. You've heard here me saying. Okay, right now it seems as if everything's fine. Okay, yes. Okay, so I will just continue then. Yeah, so what can we expect from the Fed next week? So first of all, I think it's a done deal, in fact, that we can expect them to hike rates. So in fact, the current level of rates is 100 to 125 basis points. So this is the current level. So what you can see here is that we have 100% chance to see a rate hike next week, because 90% of the market participants here, this is, by the way, the Fed Watch tool. You can look this up yourself. 1 second. I will just give you here a window. 1 sec. So if you Google Fed Watch tool, you can get the same thing. And it's not just for next week, but you can find the expectation from market participants here till next year. So in fact, till next year, November. So, and these are the current expectations from market participants here around the Fed decision next week. And then you can easily, I mean, we can skip January and all the months between March, June, September, and then December here, because these are not live events. And that's one of the reasons why we shouldn't expect big decisions here. But for example, the March decision is interesting, because here you can see that right now, we have a probability of a rate hike by slightly more than 50%, the market expectation. So with this in mind here, this is already what the market expects in 2018. In fact, if you continue to click here through those live events, go to June, for example, what you can see is that the market, in fact, does not see a further rate hike than only one right now in 2018. So with this in mind, if you click through this, with this in mind, we can say it's a done deal that next week there will be a rate hike, no matter what. The only question is, will there be one? Yes, 90%. I'd say 99%. There are 10% of market participants here saying that there will be two hikes, so that the Fed will hike rates by 0.5%, respectively or 50 basis points. And so the thing is that the NFPs, again, tomorrow won't change that. So it doesn't matter if they disappoint, if they come out. Right now, they're expected. I guide you through this in a few seconds here. Right now, it's expected that there will be 190,000. And this number, even if it is zero, even if it's minus 50%, minus 50,000, won't change the decision next week. Probably it has an impact then, at least in terms of speculation, around the decision which we will see in 2018, yes, but it won't change the decision next week. And so with this in mind, we can say that how likely is it that the NFPs tomorrow, and it's a data set which covers the employment situation in November, how likely is that from a big perspective, or from a macroeconomic point of view, that these numbers tomorrow will really affect the decision in the upcoming 12 months in terms of monetary policy? I think that here also we can say, we will agree that definitely it will be really difficult for one data set, for one NFP reading, to affect the upcoming decisions. So saying all that, or sum it up, we can say that this will be, most likely, it will be a non-event tomorrow. And by the way, we have seen that the market did not react here at all to the latest data sets which were published. Let's have a look here at the last 2 days. So Tuesday first, on a 50-minute time frame, and then also let's have a decision on what happened yesterday. So it was the 5th of July here. Have a look here. These were the data set ISM non-manufacturing, this candle here. So, and as you can see, no big volatility at all. So it was really a non-event already. So the market right now, what drives volatility is the tax reform, which is discussed in the Senate in the US, but it's not those data sets here, especially around the ISM non-manufacturing. Even though we have to say ISM non-manufacturing, there was a time when those numbers were really driving the markets. And there's also a subcomponent here called ISM employment, which came in below expectation. And usually it's a very good indication for the non-farm payrolls. So all in all, you definitely expect this then to drive the market, especially drive a currency pair like dollar Japanese yen, which is usually known to be very sensitive in terms of yields here. So, and in fact, it didn't move the market at all. So, okay, yes, you can see here a slight drop, 112.75 down to 112.67, but this is 8 pips. This is nothing. It looks big, but it's nothing. So now let's go to yesterday. It was 2:15 p.m. German time, so 1:15 p.m. GMT. We had the data set ADP employment situation. ADP is also an indication. That's something I showed to you here in a few seconds then. So this is, which candle? This one here, this candle. It's 1:15 p.m. GMT. This candle, nothing. So the candle itself is 13 pips, it's 15 minutes, and the market didn't move at all. So one other hint that right now the market is driven by other things than economic and especially employment data here. So, and one thing I'd like to show you here, a website which I highly recommend, by the way. 1 second, please. So here I am again. So you can look up all economic data, nearly all economic data at this site for free. Tradingeconomics.com. Again, I highly recommend this. And here you can not just look at the GDP or something like that, but also at numbers like the ADP at employment change. Yesterday it came out. You can see it here. 100,000 workers in November were hired for private businesses, which came in below 235,000. That was the number from October, but better than expected here, which was 185,000. And now what you can do is you can do something, you can compare it to, for example, the non-farm payrolls here. And what you will see is that the blue line representing ADP employment situation, while the black dotted line represents the NFPs here. What you can clearly see is that those two lines somehow correlate with each other. So, or let's put it different, here it's very extreme. You can see that if one data set, in this case ADP on Wednesday, disappoints, for example, on the downside, well, NFPs are likely to disappoint too. It's not that often that that there's a divergence between them. It happens, nevertheless. Here you can see that. I'd say back in 2013, 2014, somewhere here, the numbers around ADP, for example, came in as expected, and then NFPs disappointed. Yes, okay, fine. But nevertheless, you can see there's a clear correlation. There's a clear correlation between those two. And if you combine all this, again, you have a potential non-event tomorrow. So it's not very likely that the market will completely go berserk, let's say, and move up and down. But nevertheless, there's a chance that volatility is triggered thanks to the order book thinning out and liquidity drying up here. And let me just do this here because it interesting for the German audience. And so I'd like to, this is a German word for order book, okay? It's Orderbuch. But what I want to show you is, let me just see it. Usually I work with this here. This one is great. So let me just click on it. Oh no, it's, no. I want to have this here. So this is an order book, okay? So some of you might have seen around the non-farm payrolls that, and this is something I'll do here now because it's easier for me to explain my thoughts here to you. So some of you might have wondered, let me just do it that way, might have wondered what happens around the NFPs. So what happens here? I mean, it's around this employment situation, okay? It can somehow act as kind of fundamental driver, probably result in the trend developing right now, probably triggering an acceleration here in the current US dollar movement on the upside, while gold probably is pushed lower. Let me have a look here, for example. Okay, so gold obviously is accelerating right now on the downside and reaching, or nearly at least focusing the target I was mentioning during the morning meeting here, around 1,250 USD, respectively. I said I'm more aggressive here, and I think gold has some further potential on the downside, especially if the data set tomorrow disappoints. It's not that it changed something here in terms of the overall economic outlook or the monetary policy from the Fed, but it's another potential driver in direction of the current momentum, which is clearly gold down, respectively gold bearish, and dollar up. It's not sad that it will change here the overall picture in the US dollar, for example, and it will change this clear downtrend here and probably push us back above 95. But nevertheless, it's likely that if the numbers come in better than expected, it will drive, where it will move the markets in direction of the current momentum or accelerate the market, the moves in the current direction. And that said, the interesting thing, nevertheless, is why are non-farm payrolls in general are a potential driver here in direction of the current momentum. And the reason for that comes down to the order book situation around the non-farm payroll. So some of you might have sit in front of the screen here around the non-farm payrolls and have seen the market go completely volatile, going up, going down, shooting in one direction, shooting in the other. There might have been situations where you just wondered what the ... is going on here and who is trading that. And now the thing is that, in fact, you can say that it's not many which are trading that. And you can see that by the fact that the market is going up and down. So what am I saying here is the following. So what you see when the market goes strongly down, respectively strongly up, is mainly due to the fact that market participants are deleting their orders in the order book. And if you look, for example, at the spread around this time, you will see that that the spread widens dramatically. So, for example, let me just, I'm not sure. One second, I just have to look this up. I haven't prepared this, by the way. That's just an idea I had now, and I want to present you these thoughts here. One second, please. I'll just see whether I can find such a... Yes, I can. That's perfect. One second. I'll just do the following here. So let me just snipe this here too. So this is a chart from JFD, or respectively, not from JFD, but it's a chart covering the obvious maximum Euro-USD spread here during the non-farm payrolls in October, so 2 months ago. And what you can see is, so obviously I'm using this chart here right now. I can use it because it's an event exclusively for JFD brokers. And obviously JFD is just very, very solid in terms of the maximum spread here around the non-farm payrolls. And what you can see is that the spread aggressively widens here during such a news event. And so now it comes down to the question is, why does one broker have a wide spread while others here on the downside, while others have a very, very narrow spread here? In fact, it depends on the model, the business model the broker is running. So let's say you have a market maker, a broker which is taking the other side of the trades here. Well, usually you expect them to try to profit from the volatility here and try especially profit from traders who don't really know what's going on here. and they can, the more they widen their spread, the more they can profit from the missing knowledge of those traders. Then there are traders which are so-called pure DMA, 100% DMA SDP brokers, like JFD, like Tickmill also. And those brokers, what they do is they route the order straight over to the market, to the interbanking market. So they have liquidity providers in the background who provide them with liquidity and who are taking the other side of the trade. So at least there will be someone who's taking the opposite trade, this side of the trade. Sure, that's clear. If you want to buy, there must be someone who wants to sell, and that's the other way around. So that should be clear. But the deeper and the wider the liquidity pool these brokers are using, the wider and the deeper it is, the more attractive the spread, the more narrow the spread can be, because those market participants, they are still battling for the best bid and the best offer here to get the business done. Okay, so you are not considered to be part of the other side of the trade if your bid is not attractive enough. So if you have 20 liquidity providers, while one bid is, let's say, 10 euros, while the other is bid for 9 and the next is bid for 8, well, the one with the bid for 10 gets the fill, okay? And so these market participants are battling for the best quotes. It's the same for the offer. And so what you can clearly see here in this example is that the spread obviously widens, and it's natural that it widens, but the narrower the spread is, even though it widens, the narrower the spread, the more likely you are working with someone who's really routing your trades over to the primary market, in this case, the interbanking market here. So now let's come back here. Let's come back to this order book situation, how it looks like. So right here, what you can see is that you see someone being bid. These are the bids. These are the offers here. Someone, you can see a quote here. If you look at the order book situation, you can see a quote here, which is 7,245.5 to 7,543.5. So, okay. So what you can see here is, one second, please. I'll just make this a bit bigger. So what you can see, why is that? Very simple. You have someone who's willing to buy here at 42.5, and you have someone willing to sell at 43.5. So we are not looking at the depth here behind. If you now come up and say, okay, I want to sell, let's say 10 lots or whatever, and you only see 4. So probably these are ice pick orders and all that. So this is purely theoretical right now, and nothing we want to look at here. But what we want to look at is, why is the situation it is here, and why is the quote it is? And it is because we have one bid here, so 4 in fact who are willing to buy, and we have 1 who's willing to sell here at 43.8. Okay, so, and now what happens around the non-farm payrolls is the following. So the market is drying out because no one really knows what is the data set. How does it look like? So what do I mean is the following. Just imagine it to be some kind of room which has no windows, which has just one door, which is locked, and you have journalists sitting in there, and they can prepare their statement. They can prepare the statement around the non-farm payrolls and how the numbers come in. And then at 2:30, respective 1:30 p.m. GMT tomorrow, Friday, there is a barrier which is just taken away, and then shoot out their news here, and they give away the news here. So there's just a small group of people who knows this number beforehand. They are not capable of communicating it with the outer world here, or communicating it via their smartphone or whatever, and then they just shoot it out. So that's how you can imagine this number to be published, if you want, and how it's possible that for example Bloomberg Terminal or Reuters or whatever have or it seems as if they have the data first. So they have it because they have someone sitting in this room which has no windows, which has just one door, which is locked, which has no connection to the outer world here, right before the non-farm payrolls. And so that's how these numbers then finally hit the market, if you want. So that's just to illustrate how this works. So nevertheless, the thing is that most market participants, whom you can see here to be aggressively bid and aggressively offer, well, they just don't know how the number comes out. And what do you usually do when you do not know what happens next? I mean, these are professional traders. They're risk managers. So what do you usually do is you just step back. You take out the order, and or your or theirs, depends on your trading approach, and then you just step back and you wait until finally you have the number. The situation calms down. You can have the time to interpret the number and then position yourself again and put in the order into the order book again. Okay, so what does this mean? It means that naturally those orders are deleted beforehand. Let me just say, oh, I'm sorry, no, that's the wrong one. Let's just take this one here and say we're taking out all the orders here in this range. Whoop, they're gone. What's the next price you will see? So, or what's the order book situation right now? The order book situation is very simple. It's someone who's willing to buy at 7,540, and it's someone willing to sell at 7,546. So obviously, the spread, which was 1 point here, is now 6 points. And the interesting thing is that if you look at the chart, and if you look at the current situation here, for example, let's say the DAX, or let's go back to dollar yen, for example. So what do you see here? Well, this is the bid, okay, and something you can see here, by the way. So it's a JFD. It's another platform. It's a guidance platform here. It's an external platform I do my research on, and it's a German platform. That's also something I'd like to add here. And what you can see is that's the bid, okay. So what will you usually see in this moment? Well, you will see that the market drops because the bid now is not 245.5, but it's 2540 here, okay? It's 5.5 lower. And if you do the same thing here and look at the chart, but don't have the bid here, but the offer, it's the other way around. And that's one of the reasons why the market jumps from one direction into the other. You can easily see that. And by the way, it's also possible. That's something I'd like to show you here. One second, please. I just hope that it's not killing the connection right now. I just want to open my MetaTrader here, because now the next question is, and this is usually a question I receive all the time. It is, hey, Jens, when is the right time to position yourself again in the market? It's a very simple answer to this question around the non-farm payroll. So people come up and say, hey, what shall I do here? When is the right time to consider engagements anymore, again in the market? And it's, in fact, it's very simple. It's very, very simple. 1 second here. I'll just show you here the account. Right now, reason for that, Christmas rally here, try to anticipate a break back above 13,200 points, and worked out quite well till the morning. As you can see here, the market pushed as high as 13,081 points, and I positioned myself already yesterday. So you can see I was ahead 150 points, and right now the market dropped back towards 13,000. Let's see whether this works out or not, but this is not part of this presentation here right now. So what's more interesting is here, this one. So what you can do in the MetaTrader is you can add in this overview, you can add the spread here on the right side. So you can see it here. It's right here, for example, for Euro USD, currently 0.3, 0.45 pips right here, okay? So you can see there, it's obvious. Usually you have to put a 0 point before that. And this is right now the spread. Something you can also do here is, for example, look up the current spread on the website from JFD Brokers, the average spread. So you go to jfdbrokers.com, and here, this is the German website. 1 second. Let's go over here to the English one. And now scroll down. And what they do is they show here the quotes on their website and here the average spread, for example, for your USD. So why do I tell you that? It's very simple. You see that the average spread right now is 0.26. So if you look at these numbers here tomorrow during the NFPs, what you will find out is that the spread widens up to 40, probably 50 points. So the max spread as seen here was 41, for example. Okay, you have to put a 0 point before that, respectively. If the number goes up to 4.1, or here in this case 41, it means that the spread is 4.1 pips. Okay, so but this is what you can expect here to happen then. But if you know that the spread on average is 0.2, 0.3, 0.4 pips, then you know when liquidity comes back into the market and when it's the right time to position yourself again. Because now the thing is, the data comes out and the spread widens because no one really knows, and all those market participants are lifting their bids and lifting their offers. They just take out their orders. The spread widens. Now, the next thing is the data comes out, you look at the data, okay, you can interpret it. Okay, you know what the number is like, and you can see the reaction of the market because some are more, they look for risk and they say, okay, you know what, I'm willing to take this risk right here because I think I can anticipate a move in this or the other direction. And the market drives the price action, the momentum in one or the other direction. What will happen is that after the data came out, that over, let's say, period of 30 seconds to 1 minute, liquidity comes back into the market. And what you see is that then for something like, I don't know, 1 minute, probably 2 minutes, what you can see is that the spread goes to, let's call it normal. Let's put this in quotation marks. But what you can see is the spread is it gives you an idea of how deep and how liquid the current situation in the market is. The wider the spread, the more illiquid it is, and the more difficult it will be for you to be profitable in this market environment, especially in such a deep market as the currency market is, for example. And this is what's going on here and why the spread widens. So it's not because your broker wants to play games with you. So probably, yes, there are brokers out there who are playing games with you. But you can easily spot those brokers by, for example, looking at those stats here and then find a good solution for yourself and say, okay, I'm trading with those brokers who are routing my orders right over to the primary market. And offering a 100% DMA and SDP model. So that's it around the situation with brokers, spreads, why they widen, the situation around the NFPs. And now let's come back. Why is this important and interesting here for the markets tomorrow, even though it's likely that this event tomorrow will be a so-called non-event? It's very simple because, for example, the problem is, and this is a little unfortunate, let's say, but that gold, for example, hasn't broken the significant crucial support here around 1,260 USD per ounce in the morning today, but was trading here around this level, not just today, but also waiting for the non-farm payrolls tomorrow. If the spread now widens, what happens is that the bid obviously is lifted. So the market is down already, as you can see here. So the momentum is clearly to be found on the downside since last week, Wednesday, I think. Yeah, Tuesday, Wednesday. And so if now the bids are lifted, it means that the market potentially drops below this level because now someone is offering or is willing to buy below this level. But if this starts to trigger stops, because now you have to understand that here you can only see limit orders. You only see the limit orders. You don't see stop losses or something. It's really crucial to understand that and to grasp this concept. So what you don't see is how much market orders are there currently. So if a certain level is triggered, for example, here in this case, I made the assumption that we're going down to 7,540, and now say we have. Let's just assume these are the only 26 buyers you have here at this level. And now let's assume that exactly with 7,541 or 7,540.5, there was someone who placed a stop there and was willing to sell, let's say, 1,000 contracts. The market just can't absorb this volume here. And it will usually just absorb here all those buyers, but then the market will keep on pushing lower as long as those 1,000 contracts are absorbed from the market. And if you look at the importance of this region here, I mean, we're talking about the October lows. You can see that here the possibility is quite high that the market can't absorb the volume which comes to the market the moment we are dropping here below 1,260 and find a bid somewhere below that level. So it's something you can also see here, by the way. The market keeps on falling all day long. So we triggered this level somewhere in the morning, and you can see the market is all day long here, after dropping below this level somewhere around 5 a.m. GMT, is offered all the time. The market can't really take a breath, but it's just moving lower because there's always more supply than its demand, and that's the reason why the market keeps on lowering here and keeps on falling. And this is something which you can see very dynamically happen around the non-farm payrolls, and that's one of the reasons why, especially in those yield-sensitive markets like gold or like dollar Japanese yen, for example, around those events which usually result in volatility around in those markets here, when such a data set is published, that this usually then creates, thanks to thinning out liquidity and drying up liquidity, results in, let's call it a domino effect here, the market really accelerating then on the downside. So this is something where I have to say that even the non-farm payrolls, even if we consider it to be a non-event tomorrow, that it's nevertheless likely that it can trigger further momentum on the downside, especially right now, for example, in gold, but also in the dollar Japanese yen here, if the numbers surprise to one or the other direction. It doesn't necessarily mean that it is a fundamental game changer, but it's probably it's triggering some action based on this, let's call it domino effect idea I just presented. So 1 second, by the way. I'll be back in 10 seconds. Okay, here I am again. Okay, 1 second. I have to just see whether there are any questions. No, there are not. Okay, yeah. So what I prepared on top of that is a small scenario tableau here. Scenario. No, I think it's tableau in German. It's table. It's just a table. I've prepared 3 scenarios here, even though I have to say that so far it looks as if already here, especially those who are bullish the US dollar, are already triggered somehow, especially if looking at the Euro USD, for example, which dropped below 118 already. The same is true here for gold. You can see neutral to bullish. That was a preparation I did already yesterday. And as you can see here, the break of 1,260 already occurred. But what is more interesting, I think, is here, especially the consensus, what the market expects. By the way, you might wonder where I get this data from. It's very simple. Let's go over here to Bloomberg. You can look this up yourself, and I highly recommend it, by the way, if you plan to prepare this in the future for yourself here. You can here search for, I'm sorry, no, you don't need to search it, in fact. So what you can do is, let's just close this. You can go here via menu, and then you scroll down to economic calendar under Bloomberg Markets. If you open the economic calendar here, you can see that's completely for free. You don't need to do anything here, just to join Bloomberg.com. And here you have December, you have Friday the 8th, that's tomorrow. You have the deployment situation. You just click on it, and then you'll find everything around the prior number, 261,000, the consensus for tomorrow, 190,000. You have the consensus range, 153 to 250,000. You have the unemployment rate expected at 4.1. You have, for example, here, this is the most important number probably tomorrow. It's the average hourly earnings. So one might wonder, why didn't the US dollar really react bullish towards the last situation, the employment situation here with 261,000? Well, that had mainly to do with the fact that the average hourly earnings came in below expectation at 0. And in fact, average hourly earnings, this is the number which is potentially or most likely to trigger any action from the Fed, even though it won't trigger any action tomorrow too, even if it comes in, let's say, -2. I don't think so, but yeah, but even if it comes in below expectation tomorrow, which is, by the way, 0.3, it won't change the decision from the Fed, but probably has some impact on the expectation from the market for next year in terms of rate, the rate decisions here, the monetary policy from the Fed. But here is, and this is what we want to focus on right now. I think the market just changed too much based on the current action here in the US dollar again. So first of all, gold pushing below 1,260, dollar Japanese yen. Okay, that's, yeah, well, I mean, that hasn't changed so much, the picture, in fact. So dollar Japanese yen is still range bound, and think that with a disappointing data set, for example, we have a good chance here to drop below 112 again. Same is true probably for EURUSD, even though I think 119.50 is a little too much on the upside. So probably we'll make it back above 180. Probably we can stabilize above that level. And this all comes down to a number which is coming in below expectation. So consensus here is 190,000. NFPs come in somewhere around 150 to 180, let's say, which is in fact a little unlikely because the ADP data set already came in very solid. And on the other hand, chances are still there that the numbers disappoint because the ISM employment components of the ISM manufacturing and non-manufacturing came in below expectation. But yeah, all in all, I think the scenario itself, I haven't put a probability behind that, but I think the probability for this scenario here, the numbers disappointing tomorrow, is something like 20%. I don't think so. So I think numbers will come in as expected. This is the next slide. But let's nevertheless look at this first scenario here. Numbers come in below expectation, 150 to 180. Unemployment rate is somewhere around or above 4.1, and average hourly earnings come in slightly below expectation. So 0.3 is the expectation, 0.2. Well, this, as again, that could result in some the US dollar losing some of its current momentum here, even though, again, we have to admit that the data set itself is not that action promising at all. Let's have a look here at the second slide. So second scenario, again, these numbers didn't change, consensus 190 and so on. And if these come in as expected, somewhere between 190, slightly positive, around or slightly above 200,000. The unemployment rate comes in as expected, 4.1, and the average hourly earnings come in bigger than 0.2. 0.3, probably bigger than that. This is something in the current market environment which usually should trigger bearish US dollar action here. I'm sorry, not bearish US dollar, but bullish US dollar action. So Euro USD bearish, or dollar Japanese yen bullish action. So everything which is bullish for the US dollar, and it should right now somehow, depending a little on how much the market right now anticipates already, but probably accelerating the current momentum on the downside also in gold here. So we should then probably dip below, in this case, 1,250. So as again, we're already broken the level here around 1,260. In dollar Japanese yen, it gets really interesting, in fact. So let's focus probably a little more on dollar Japanese yen. The thing is that I myself was already willing to go long dollar yen again. So I was long last week, was unfortunately stopped out break even. I was long around 112 last week on Thursday. then stopped out through this fake news here, break even again. So I got lucky here to this fake news from this guy from ABC, Brian Ross, who said that there was contact between the Russians and Donald Trump, respectively his team, before or around and during the election, which is not true. There was a contact, yes, but it was after the election last year, and it was a connection in terms of an alliance they plan to form with the Russians here to fight ISIS. So the thing is that it's definitely fake news. Triggered definitely, nevertheless, some big volatility, and I was unfortunately stopped out of this position. And the reason why I say unfortunately is very simple, because I think that dollar yen has definitely some potential on the upside, and especially once we make it back above 113. So let's have a look here at the 1 hour chart. I'm sorry, 4 hour chart it is. If we break above that level here, 113, I think the next target on the upside can definitely be found somewhere around 114.50, 115. So with a stop here below the lows from yesterday, so this is here 111.97 around. We have a risk of something like 100 to 115, 120 pips with a target of 150 to 200 pips on the upside, resulting in an overall risk reward which is somewhere around 1 to 1.5, probably slightly higher than that. So this is probably very attractive and could be triggered, this scenario. So the push above 130 could be triggered if the non-farm payrolls come in as expected, respectively slightly above expectation. Especially, this is likely to happen if the average hourly earnings come in better than expected. So if they come in significantly above 0.2, not as expected 0.3, but 0.4, 0.5 month per month, I think this is a good, very likely scenario then to expect dollar Japanese yen to really push aggressively above 113 and go for 114.50, 115 in the next days and in the next week. If the Fed on top of that comes out hawkish next week and talks about the fiscal stimulus here from the US government, if we combine all that, then usually, and it's probably indicating that there will be not just one, but another 2, respectively 3 rate hikes in 2018. This could definitely then be the final accelerator here to push dollar Japanese yen towards 114.50, 115, I think. And yeah, so I think if I had to put a probability on that, I'd say this is the most likely scenario with something like, yeah, probably 60% happening and another 20% for the third scenario, which is ultra bullish dollar in the current environment. I'd say numbers come in above expectation. The unemployment rate comes in equals 4.1 or is below that 4.1, and the average hourly earnings again are beating expectations here, and that definitely is likely then to trigger further momentum on the downside. Euro USD, it's likely that we push towards 117. By the way, this is then also a potential driver on the upside for the DAX and a potential driver for a break of 13,200. By the way, right now the DAX is highly correlated towards the euro. And by the way, I just have a look here. What's happening? Yeah, not so much. So I'm still confident. By the way, let me just give you an example right now on my trade. You've just seen it here. So what do I want to see here right now is the following. What I'd like to see is the market now, for whatever reason, push to new highs, make it above 13,100 points. If we can do that, right now I was planning to just hold the trade here at break even, and that's it. I then trail my stop towards the lows from today. But therefore, we need to break today's highs, and we need also to break above 13,120, so the weekly highs. Hopefully, this will happen tomorrow then, but this is the plan then for the trade. So if we see this break higher, probably it happens today. For whatever reason, the US equity markets are shooting through the roof again and going Bitcoin or so. I don't know. This is then one good reason to move the stop here towards the current daily lows, which is 12,985, and this would already save me something like 55 points or so. But right now I'm still patient here and I have to wait for this. Again, This driver here, nevertheless, could be found in good NFPs tomorrow, since it's likely that this will trigger an acceleration here on the downside, trigger further momentum in EURUSD, pushing us towards here, the region of the lows from the 21st of November, the region on 17. And if we push to this level, this could then definitely trigger another bullish move here in the DAX, pushing us towards 30,100 points minimum. And if we make it above that level, by the way, the next potential target then is 13,200 points. So meaning nothing more than, if we make it above this high here, the current high, by the way, also from the 21st of November, is that? No, it's not the November high. If we make it above that level, this is my catalyst for a potential Christmas rally, and then also making it possible that we push towards the all-time highs to Christmas here in the DAX, which is, by the way, also one target you can imagine I have in mind when looking at the current trade. So I think I really got it right yesterday. I really entered the market at the right time, and so far got lucky that I wasn't stopped out. And now the target is that we just make it above 13,200. If we make it above that, well, then there's a good chance that that will trigger further bullish action here, and I will just keep let this position run and hopefully make it up to the all-time highs here. And so this somehow closes the cycle here in terms of my outlook for EURUSD, and somehow why I hope that a very, very strong data set tomorrow comes out, because it's likely that the US dollar will react bullish to this, and then that here this will trigger some further bullish action in my trade and push it towards the region I'd like to see. But let's come back to the yield sensitive markets, dollar yen and gold here. So for dollar yen, I'm definitely bullish then, and I definitely see a high chance that we will significantly push above 113 and see the test of the region of 114.50, 150 in the next days. Also likely that this will happen before the Fed, even though, again, the NFPs don't change anything in the overall picture. But nevertheless, right now, the yield differential between 2-year and 10-year yields is, or the yield curve itself, is the flattest in over a decade, meaning that such a surprising data set here, even though it doesn't change anything in terms of a macroeconomic outlook, is likely to trigger kind of a short-term yield rally, let's say, especially in 10-year notes, which are currently net long in the commitment of traders report, meaning that something like 100,000 contracts, if I remember right, which means that if the data surprises on the upside here, that could trigger some selling in T-notes and pushing yields higher than that way, and reacting or triggering some bullish action in dollar Japanese yen, which is highly positively correlated towards those 10-year T-note yields. And yeah, for gold, this is definitely a bearish trigger, and I could imagine then to accelerate the momentum and probably seeing gold reaching the region around 1,240 USD per ounce already. Probably we'll make it even lower than that, but yeah, currently this is it's unlikely that such NFP data sets, which surprise on the upside, even though it doesn't change an overall macroeconomic picture, will not accelerate the current move here in gold. And it's also not that likely that even if the data set disappoints, it will somehow reverse the current action. Well, let's put it differently. I definitely step away from anti-cyclical long positions in gold right now. So my outlook I had at the beginning of October, when I was somehow seeing a potential golden year-end rally in gold, is definitely not given anymore. So I think the break today below 1,260 USD is definitely should be considered really bearish. By the way, it hurts. It really hurts to see that. Some of you who followed me in the morning meeting might have seen this last week already and wondered what happened to my trade. I was short gold right from here, from this region. At one of the morning meetings last week, I exactly described why I went short. That was due to some very interesting volume action, price action taking place here. last week on Monday already. That was on the 27th of November, and it let me come to the conclusion that probably gold short is not that bad as an option here right now. I went short. It moved aggressively towards my target, which first was here lying around 1,260 USD, or no, it wasn't the target itself, but it was an anticipation of the break, which happened then today. And then I was stopped out here on this fake news also. So I was not just being dollar yen long, which is so far okay if I look at the current price action, but the gold trade, that's definitely not okay. And it's really unfortunate that I got stopped out here in the straight too, but okay, that's just trading. Let's just hope that, and by the way, I'd like to add something here on top of that. Some of you might have followed me yesterday. I made the potential retest of the region 270, 271, a potential short trigger, and I was looking for this level to short again and then anticipate the break here, which happened then in the morning. Well, as you can see here, we were traded as high as something like 1,269.50. So I missed this trade for another 50 to 150 USD per ounce too. Well, again, I had a nice trade in gold at the beginning of October. So nevertheless, it could have been a golden year and close for me too, if those two trades worked out as expected. Unfortunately, they didn't. Yeah, so let me just see whether there are some questions. Okay, I'm not sure. You mean what's my picture for USD? I just hope that I've just seen the question right now. I hope that everything I just said around the USD made sense for you, because I covered it quite in depth here, I'd say. So currently, I think the most interesting currency pair to watch, especially around the NFPs, is dollar Japanese yen, not Euro USD. Euro USD, nevertheless, is interesting for me, since I think that if Euro USD continues that momentum on the downside and pushes towards 117, probably triggered thanks to non-farm payrolls, which coming better than expected, that could trigger some bullish reaction in my current DAX long trade, since Euro down is right now strongly correlated with DAX going up. Yeah, and I just hope that this answers the question. And a final question, yes, around Australian dollar against the US dollar. So I made this a topic already in the German version of the morning meeting here in the morning. So that's a key support which was broken. Yesterday, there was one of my students asking me whether how I see Australian dollar USD. And I said, well, if we make it back above 76.50, that could trigger some bullish action. The reason for that is simple, because for several months now, have a look here at this. So it's very interesting. We have definitely the potential here for an inverse head shoulder formation. So here's the shoulder, left shoulder, here's the head, here's the right shoulder. And then we see the market dropping, breaking out of this formation and then pushing back here and seeing a retest of the neckline. And so here, now you wonder, how can I enter the market? And I said, very aggressive entries potentially once we make it above 76.50 here. And then we could give it a try. It would be a long-term trade. In fact, long-term trade, this picture is completely, yeah, it's gone. It's not valid anymore, because we made new lows here, and the market forthrights its structure, falling highs and falling lows. And so far, as long as we don't make it back above 76.50, the picture is clearly bearish in Australian dollar USD. And we have some further potential here on the downside, 73.30, 73 in the upcoming days. So clearly bearish. So definitely no other choice than being on the short side or stepping back if you plan to be long. But long is an option only if we make it back above 76.50. Yeah. So, and that's it. So I just hope that you enjoyed this presentation here. And if you have any further questions, please shoot me an email or contact me via Twitter. It's at Jens Klatt FX, or shoot an email over to JFD Brokers. We definitely have several ways to find together here, and I will, yeah, I will see or we will see what the NFPs will deliver. And I wish you happy trading. Watch your stops, and talk to you again then tomorrow, hopefully in the morning meeting, 10:30 a.m. GMT, the YouTube channel from JFD Brokers. So happy trading. Watch your stops, and take care. See you, and bye-bye.